That's because it is these two metrics that will determine shareholders' equity. Now, if a company is doing well, then its current asset, this very particular one here, its current asset should be 1 times above its current liability. That is to say, when you divide this very particular value by that of current liability, which is this very particular one, you should have more than 1. So when I say 124 divided by 139, you can see this is less than 1. That is to say, there's a problem. The company does not have enough assets that can easily be convertible into cash. So in situations like this, you might begin to see the company is investing its money in something else, which you have to dig deep to understand if actually there is an investment going on or if there is no investment going on. But ideally, when a company is doing well, this very particular value, when it has been divided by the current liability, you should have something above 1. It should be more than 1. I hope you understand this. So that is how you estimate that. Then at the end of the day, when you look at the total asset and the total liability, after deducting this from this, then we have something called the shareholders' equity, which is exactly what is interpreted as total equity gross minority interest. And when you collapse this very particular one, you can see something called the stockholders equity, which is this, and then minority interest, which is this very particular one. Then when you sum this and this together, you have something like this. Now if I collapse them, this is exactly what I have across different year. So when I look at this very particular one, we say okay, this is 86 billion. From that we increase it. From that it was increased to 106 billion, and then it was increased to 114 billion, then it was also increased to 122 billion, which shows that the shareholders equity is actually on the increase. And the reason is because the original asset is on the higher side and then liability is a bit lower than the asset. So for now, it is rational to say that this very particular company is actually on a neutral level. It might not really be doing well, but it's actually on a neutral level because losses are not being made. I hope you understand this. So this is how you go about analyzing balance sheet statement of a particular company. Now, all this information that you see here does not actually reflect into the balance sheet in terms of analysis, but it can also be included because they are key metrics that are used in evaluating some of the activities or some of the values that you see inside total asset or total liability. For example, the total capitalization of the company is 182 billion. Capitalization is more like the net worth, the value of that very particular company. Now, when a company liquidates, this amount will be the value that will be used to settle its shareholders. That is what capitalization means. And this has been captured here as 182 billion. That means this company has enough money to settle a debt. Because when you look at the total equity that shareholder has, it's just 122 billion, and then total capitalization is 182 billion. So this very particular amount can be used to settle this very particular value just in case something went wrong. And the same thing applies to all the information that are displayed here. Now these are other information such as the common stock equity, capital list, non-tangible assets, working capital, investable capital, and some other information that are captured at the bottom side here. So like I said, in analyzing the balance sheet statement of a particular company, the aim is to get a particular value of asset that is above the liability of that very particular company. It's a very simple mathematics. If the assets you have is more than your liability, then you are doing well. You might not really be doing very well, but on a neutral level, you should be good. But when your liability, the bills you are paying, the people you are to pay is more than the amount of money or the assets that you have, then there's a problem. Because as time goes on, you might go bankrupt or you might begin to owe too much amount of people that you cannot pay back anymore. So the aim of balance sheet is basically to make sure that a company's asset is more than its liability. I hope you understand this. Now, when we go back to our Excel file, you come to see that we have a particular evaluation metrics by the side here. So if I want to extract the company's asset from this very particular place, so I'll select this and then copy it from here. Then I'll come back to the Excel file and then paste them here, and I'll have something like this. So let me double click on this, then add 3 more zeros, 1 2 3, so as to make the final value in billion. Then I will go back to the same sheet, then I will extract another information which is its current liability. We are dealing with that of 2022, so I'll come down to current liabilities, then I will extract this, then I'll copy it from here, go to Excel and then paste it here. Then I'll add 3 zeros at the end, 1 2 3, so that it can become in billions. Now, to calculate the ratio, what I need to do is just type the equal sign, then go to this very particular cell and then divide it by this very particular cell. That is the current asset divided by its current liabilities. I hope you understand. When I hit enter, this is the value I have. Oh, sorry. What I did was to calculate the total assets. So this is not what I'm supposed to use. I will have to expand this and then take this very particular value here. This one. I will copy this one instead and then I'll paste it here. So that I can now add the zeros at the end. 3 zeros. Then the same thing for that of current liabilities, which is this. Then I will copy it from here, go back to Excel, then I paste this, then I add 3 zeros, and this is exactly what I have. Now, after dividing this by this, the value of the ratio I have is less than 1. Now, since it is less than 1, that is to say the company does not have enough assets that are easily convertible into cash, because the number of liability that are easily paid, that's because the number of liability that the company needs to pay within 1 year is more than the asset the company has that can generate income for it within 1 year. I hope you understand this. So that is what this very particular ratio is trying to communicate. Then under the bottom side here, we have debt to equity ratio, where we look at the total debt of a particular company and then divide it by the shareholders' equity. This is exactly what we are trying to achieve here. That's the information displayed here, where you divide the total debt by shareholders' equity so as to have the ratio of debt to equity. Now, debt to equity ratio is a ratio that shows the value of shareholders' equity in relation to the money the company owes. Now, to evaluate this, you need a particular metric, which is total debt. So let's go back to the financial report and see where is our debt located. So debt is a liability. Now, when we scroll down here and see where is our debt, probably it could be, okay, we are still under asset, sorry. Let's go to liability. So this is the current debt and capital of so this is the company's current debt. So I will just copy this very particular one from here. Then I'll go back to Excel and then paste it here. So I double click and add 3 zeros at the end. Then I go back to the same sheet. This time around, I'll be looking for the company's equity, which is this very particular one here, the shareholders' equity, which is this. Then I'll copy it from here. Then I'll go back to this metric and then I paste it here. Then I add 3 zeros at the end. And I have something like this. So I can now introduce my equal sign, then tap on this and then divide it by this, and I have something like this. So the debt to equity ratio is very, very minimal. That is to say, the company does not owe too much number of people. Now you can understand this by looking at this value here. I have 116 billion as the total shareholders equity and then 22 billion as the debt the company owes others. the debt the company has to pay to others. I hope you understand. So that simply means the company is actually not owing too much people as compared to the shareholders equity, which is the value of this very particular ratio that we have here. So if you multiply this by 100%, you have 18% or approximately 19% debt to equity ratio. I hope you understand. So this is how you go about evaluating the balance sheet of a particular business.